Alrighty. So in today's video, we are going to get into the top 3 easiest option strategies for beginners. So if you are brand new to trading options, you have never traded options before, or maybe you have traded for less than a year, and you want something that is simple to execute and relatively easy to understand, then you might want to consider these 3 option strategies, starting off with the first one, which is the covered call. Now, the covered call, in my opinion, is the easiest option strategy to get started with because it's very straightforward, right? So the criteria is that you need to already have at least 100 shares of a stock, right? So all you have to do is sell a call options, right? Once you have at least 100 shares, right? So for every 100 shares of a stock, you sell 1 call option, because 1 call option or every option contract controls 100 shares, right? So if you have less than 100 shares, right? Let's say maybe you do not even have any shares and you were to sell this call option, then this is what you call a naked call option. And that is going to be pretty risky if you have no idea what you're doing, you don't know how to manage it, right? Because if the market is to shoot through this call strike down here, then what you're going to experience is this sign down here, right? Because if you were to open up your order ticket, especially if you were to open up your order ticket in Thinkorswim, you will actually see this sign down here, and this sign down here isn't a ribbon, but rather it's the infinity sign, right? Which means to say that you have a chance to lose infinity amounts of money. Now, of course, that is unlikely, right? But there's always a chance that you can lose a lot of money. So basically what I was trying to tell you is that you can lose an unlimited amount of money if the market, the underlying stock, just shoots all the way up to the moon. So as much as possible, you want to do this strategy, you need to have at least 100 shares of a stock, right? So let me just remove these drawings down here. Okay, so every strategy that we are going to trade, there's always some pros and cons, right? There is no strategy that is 100% wonderful, that there is no cons to it, right? So there's always a trade-off. And when you trade the cover call, this is something that you want to look out for, all right? So let's get into the pros and cons. So the very first pro is that when you sell a call option, right, you can sell it every few days, every X days, to collect some income, right? So this is a good way to generate an income, especially if you already have some stocks, right? So maybe you come from the traditional world of stock trading, or maybe you have been investing in stocks for the long term. Then why not just sell a covered call? Because when you do it this way, you can actually get some income every time you sell a covered call, a call option. You're going to get some premium, right? So this premium is straight into your trading account, right? And this can be also used to offset any losses in case if the stock drops, right? So this is a good way for you to generate some income. Now, how many days out do you want to sell the cover call? This really is up to you, right? There are people who have been selling maybe every 7 days, while some people can go all the way to every 30 days. This really is up to you, right? So there are, of course, some trade-off when you trade 7 days versus 30 days or anywhere in between. But basically, the shorter the time frame, the shorter the days to expiration of the option, right, you will get a higher ROI, which is in terms of percentage. But in terms of the absolute premium, in terms of the dollar premium, right, it's actually lesser, right? So you'll get lesser in terms of dollar premium. On the other hand, if you go for the 30 days, you will actually have a lesser ROI, right? But then you will actually get a higher dollar premium, all right? So as you can see, this is a trade-off. So which one is the one you should go for? There is no right, there is no wrong. It all comes down to your own objective and which is the one you're comfortable with, okay? Now, the next pro is that since you already have 100 shares, there's no risk to the upside, right? As I mentioned before, because of this 100 shares that you have already. So if the market really does shoot to the moon, guess what? You're already covered by the 100 shares, because a short call, if you are to get assigned on this short call, basically you will be short 100 shares, right? So if you didn't have this 100 shares, you'll be short 100 shares, which is not a position that you want to get into. Now, because you already have 100 shares, if the market, right, does expire in the money for this call option down here, that means above this strike, basically what it does is that it will just cancel out this long position which you have down here, this 100 shares. So this one will cancel out each other. So at the end of the day, basically you will have no position. So there is no risk to the upside, okay? And on top of that, most likely you will be having a profit on your stock, right? So maybe if you bought your stock, let's say at 185, right, and you get your shares called away at this strike down here, which is close to $200, then your profit is basically like this, right? On top of that, you still get the premium from selling this covered call. Now, the third pro is that it actually serves as a hedge to your long stock position, right? So maybe if you already have some long stock holdings that you plan to hold for the long term, well, selling a call option can actually help reduce the risk of you holding on to the stock, right? Because, what if the stock actually crashes? So if you have this call option, actually it will reduce the risk of this stock by a little bit, because you're already receiving some money for this, right? So this money can help to offset any drawdown that you have in this stock for the long term as well. And this call option is actually very versatile, right? You can sell out of the money, which is above where the current market is, or you can sell a call option, right, at where the current market is, or you could actually sell in the money, right? There are some people who have been selling in the money call options as well, because when you sell in the money call options, this is actually a very defensive stance. Now let's get into the cons, right? So this is the good side, which we have talked about, which is under the pros. Now, what about the downside, right? The cons. So the cons is that the first one is that if the stock is above the call option expiration, your shares will be called away. So this is one of the biggest, I wouldn't say risk, but it's the other thing that you want to think of, because you're not actually losing money, but rather it's just the opportunity cost, right? Because chances are that if you are investing for the long term, you want to keep the shares, right? You want to keep the shares for as long as you can, right? As you want, maybe for the next 5-10 years. But if it goes above this call option down here, let's say it settles down here at expiration, well, you'll be having your shares called away, and then you will have no position then. So maybe this is one of the sort of risk, right, inverted commas, risk that you are wanting to avoid, because you want to hold the stock for the long term. But guess what, even though you get called away, you can always still wait for an opportunity to get into the market again. All right, so it's not really that big of a con, but it's one of the things that people actually are worried about when they sell the cover call. So this is also in terms of opportunity cost, because if you didn't sell this cover call down here, guess what? If the market goes up, then you would have done better if you just hold on to the stock. So that's why there's the cons down here of selling the call option. But of course, as we know, the market doesn't just go straight, right, in a straight line all the way up, right? It will go up and down, right? So this is where you need to understand that there are places where you can find good opportunity to sell cover call. That means you do not have to sell it all the time, right? You can sell it when you think there's an opportunity, especially when the market is very overexerted to the top side, where it goes up, quite a bit. There's a chance of retracement. Then you could sell a cover call, right? Because as the market goes down or it retraces, right, this is where the cover call can start to make you some money. All right, so this is the very first strategy. Now, what about the second easiest option strategies for beginners? And that is the cash secured put. So the cash secured put is also a very simple way to get into trading options, because all it is to sell a put option. And the whole idea of a cash secured put is to get into buying stocks. It's to get 100 shares of stocks, right? So if you have stocks that you want to buy, then you can use the get paid to wait option strategy. Now, this is also a strategy that's being used by Warren Buffett whenever he wants to get into a stock position. That is to sell a cash secured put, right? So maybe the stock right now is $187.65 down here. And you're thinking to yourself, this is a little bit expensive. I want it to be a little bit cheaper. Well, guess what? You can actually sell a cash secured put at the lower prices, right? So let's say you have decided, you want somewhere around $180. That's where you decide you want to get long. So here you can actually just sell a put option, and two things can happen, right? The first thing is that the market actually goes down, and then you get exercised, you get assigned on your put option, then congratulations, you're now the proud owner of 100 shares at the price which you already wanted, right? That is how Warren Buffett get into his shares. He uses a lot of put options, of course, not all the time, but this is one of the strategies that he used. Now, the other option, or rather the other scenario that can happen, okay, let me just cancel this arrow, is that the market goes here, goes up, never gets exercised into your put option, or maybe it goes down and goes up again, and expiration, it is above your strike price. Well, you do not get 100 shares, but at least you get the premium for selling this put option. Okay, so that is how the cash secured put works. Now let's get into some pros and cons as well. So pros is that it is a great way to get a discount on your stock. I mean, come on guys, who doesn't love a nice discount, right? You want to buy something slightly cheaper, especially right now. You know, for example, the example which I mentioned, the price was 187, you wanted to get cheaper at $180, and the price really, the stock really went down, right? You bought at $180. Guess what? You get even more discount because now you can also factor in your premium, right? If you receive maybe $200, $300 from your premium, that is also considered, you know, you can take it off the price of the stock. So that is a good way to get a discount on your stock, right? Next, if you sell a cash secured put to collect income once every X days if you are not assigned. So similar to the covered call, you can just keep selling this cash secured put until you're finally assigned and you get the 100 shares, right? Maybe for the first, I don't know, maybe you sell 2 weeks out. 2 weeks out, the market maybe just expires here, right? Guess what? Your put option right now expires worthless. Now you can sell another put option, right? You could choose to sell at the same place, or you could choose to sell a little bit lower right now. Maybe you're thinking, oh, I might want to get it a little bit cheaper now. You can as well. And for as long as you do not get assigned, that means the market does not actually go below your short strike, you can keep selling it as a good way to generate an income for yourself. Also, you don't have to worry about any option Greeks when you plan, because you plan to get assigned, right? So one of the confusing things when it comes to trading options that many people, you know, face, especially if they're just starting out, is, you know, having to wonder about the Greeks, right? The delta, the theta, the vega, you know, how to make this, you know, all work for your option strategies. Now, this is very prevalent if you trade strategies like the iron condor, the credit spreads, the strangle, and so on and so forth. But if you actually plan to get filled, to get 100 shares on your stock, then guess what? There's no need for you to bother about the delta that much, right? You actually don't really have to bother about it. All you have to do is just take a look at the price that you want to get long at, right? You just have to decide what is the price you're comfortable to get a long 100 shares, and then you sell your put option there, right? That's pretty much it. So you don't really have to worry about the option Greeks. That is why it's very simple and easy compared to the other option strategies. All right, let's get into the cons, right? So the cons, the first is that you need to wait till expiration to get assigned, which means to say, let's say there is 30 days to expiration left on this cash secured put. All right, so let's say, for example, the market actually comes down here and then goes up here and it expires at this price down here. All right, which means to say at expiration, your put option actually expires worthless. You get to keep the premium, but you don't get the 100 shares. Now, if the market actually continues to go up all the way after that, then you would have actually done better if you had just bought 100 shares at $180, right? You have just, maybe if you place a buy order, like the traditional way of getting into stocks, just place a limit order to buy 100 shares at $180. If it comes down, you get filled. Now you're in for the ride as the market goes up. Now, of course, there's the other way as well, because the market could continue to go down, right? So if you have this put option down here, you need to know that you only can get assigned this 100 shares at expiration, okay? Next, if the stock goes up after selling the cash secured put, you would have made more by simply buying the stock outright. And that's pretty much what I just said earlier. If you bought it at $180, you place the limit order, right? If the market really does go up, then you would have, you know, made more than, you know, just selling this put option down here. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. All right, so let's get into the third and final easiest option strategies for beginners, and that is the wheel strategy. Now, this is a very, very, very popular strategy that a lot of option traders like to use, and for a good reason as well. And that is because this is the awesome combination of selling a cash secured put and then a covered call. This is the best of both worlds put together, right? You get income from both sides. So how it works is pretty much like this, right? So for this strategy, you do not actually need to have any underlying shares, any shares at the start, because you're going to get into the stock with your cash secured put, right? So that's strategy number 2, which you have already learned. So we start off by selling a cash secured put, all right? Then let's say the market goes down and then it expires below here. What happens right now, you'll be long 100 shares. You're now the proud owner of this stock. So what happens now is that you can actually sell a covered call, which is above where you got exercise. Remember, this is very important to sell it above, because if you were to sell the covered call below, then you could lock yourself in a loss, right? So once you sell the covered call, all you have to do is just see whether the market goes up. If the market goes up and then it actually expires, right, in the money, right, above this call strike at expiration, then your 100 shares is going to get called away. And then right now, you have 3 profits, right? The first one is by selling the cash secured put, second one by selling the covered call, and the third one is the profit gain, or rather the capital gain, from the difference of, you know, where you got assigned and where you got called away. All right, so again, let's get into the pros and cons. So the first is both the pros of the cash secured put and the covered call, which we have already talked about. And next is the triple income, right? If you just did the covered call alone, there's only just the covered call premium. If you did the cash secured put, it's just the cash secured put premium. But if you would do the wheel strategy as a whole, you have the cash secured premium, you have the covered call premiums, as well as the capital gains. So this is a very, very sweet way to generate some income for you. That is why a lot of people like to use the wheel strategy. So the third pro is that this is a short-term to mid-term bullish strategy that takes advantage of the positive drift of the market, right? So the positive drift just basically means that, you know, over the long term, the market wants to go up, right? So as you can see in a lot of the major index ETFs, and also in a lot of the big stocks, right? In the S&P 500, in the NASDAQ, you notice that the prices have just kept going up over time, right? So this is what you call the positive drift. So by trading the wheel strategy, you're actually already taking advantage of this fact, because the market wants to always, you know, go up in the long term. So that is why if you would choose your shares correctly, you choose the underlying stocks correctly, then, you know, you can participate in the positive drift of the market. Now let's get into the cons. Now the cons, again, both the cons of the cash secured put and the covered call. The second con is that it is more capital intensive than the other option strategies, right? So generally with the wheel strategy, you do need a pretty decent size account, all right, a decent size trading account, right? Otherwise, it will be very difficult for you to get into, you know, trading this wheel strategy, because you will be having to get long 100 shares. So if you want to get long 100 shares, you do need the capital. Okay, so let's get into the last and final cons, and this is a pretty big one, and that is the success of the strategy is dependent on choosing the right stocks. Now, I mentioned earlier that generally the market want to go up because, you know, there's the positive drift of the market, but that is not for every single stock out there. In fact, there are a lot of stocks that do not go up. In fact, they can even go bankrupt. So that is why you need to take the time to research the right stocks, okay? Because if you were to choose the wrong stocks, no matter how good the strategy is, you are going to lose money. So this is one of the biggest cons, and one of the things that a lot of people actually struggle with. So it is important to choose good stocks, good fundamental stocks for this wheel strategy if you want to be successful in the long term. So I've actually also created a number of videos on the wheel strategy already on my channel. If you're interested, just head on to my channel and then just type wheel strategy, and you will see quite a number of videos show up. Alright guys, so these are the top 3 easiest option strategies for beginners, starting off with the covered call, the cash secured put, and finally the wheel strategy. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.